Good afternoon, everyone. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. Welcome to this week's Mortgage Minute, coming to you from Palm Springs in the greater Coachella Valley area. Interesting day today. Kind of a somber day, obviously, for a couple of reasons. One being today is the 24th anniversary of 9/11. And then, of course, the awful events from yesterday. Still having trouble comprehending what happened there. It certainly gives us all, I think, cause to reflect on what's going on, what we all can do better, and try to avoid these kind of things from happening in the future. And of course, it's really tough to consider not just the loss of life from of Charlie Kirk at the Utah Valley University, but also, of course, leaving behind his wife and two young kids, babies, really. So I'm not going to talk much about sports report or the weather. Just again, I think we all need to reflect on the last events here, and hopefully we can all do better going forward. So with that, let me try to go ahead and get into our program as usual. First, I want to give you an idea what rates are at. Rates are actually pretty darn good, trending downward. Now, not by a ton. The media is making everyone believe that rates are plummeting. I think that's a bit of an exaggeration, but certainly we are getting to a very important, I think, if nothing else, psychological threshold as to rates. That is to say, breaking the 6% barrier. So you can see from our rate grid that we're at that point. 30-year fixed conforming with a good credit score, decent down payment, actually at 5 and 7/8 without any points. The 3-2-1 and 2-1 buy downs, under 3% on the 3-2-1. Yes, you can get a conforming loan with a 3-2-1 buy down, and your first year rate could be at 2 and 7/8. Sound familiar? Sound like 2021 maybe? With a 2-1 buy down, you can start under 4 at 3 and 7/8. FHA down to 5 and 3/8, and of course, look at that 15-year, barely over 5% at 5.125. So rates are definitely going in the right direction. But you know what? Keep in mind the fact that these rates are actually about where we were. In fact, actually slightly still higher than where we were a year ago in September of 24, right before the Fed lowered the Fed funds rate by 0.5%. And of course, next week is the Fed meeting where we'll talk here in a minute about what we should expect there. So Jeff's going to pull up the chart for the 10-year bond yield. This goes back the last 5 days, going back to last Friday to today. And there you can see that nice trending downward slope. That's what we like to see. No Wednesday dip, but certainly a nice little dip going into end of Wednesday and today. And of course, you can see that bond yield just over 4%, and 4.02. Now, again, a year ago, early September last year, I mean, literally about 1 year ago today, that bond yield was down to 3.61. So memories are short sometimes. So we're not at the lows. That was actually a year ago, but we're certainly heading into that direction. So obviously more good news. Rates, as I said, for quite some time have been very stable. Now we can see they're stable with a downward trend. How far further are they going to go? Well, that's to be seen. And let's go ahead and get into what's going on in the markets to help explain where or why that bond yield and rates are where they're at. Well, as it points out here on the slide at the top, it's inflation week again. So today, or actually this week, we had the inflation numbers released. And the first one was actually yesterday. That was the PPI, that's the producer price index, or inflation at a wholesale level. And that actually came in at 0.1% in August, minus 0.1% in August. So it actually dropped versus a 0.3 forecast. So that's a pretty healthy drop in the wholesale inflation number. And of course, definitely when you consider it was 0.7% increase in July. So a substantial improvement in the PPI over the month of July. Year over year, also the same story, down to 2.6% versus 3.1% in July. So that was very good news. And of course, that did contribute to that improvement in the 10-year bond yield that we've seen pretty much all week, and in particular after yesterday. Now, the other inflation number that got released today, the CPI, that's Consumer Price Index, or inflation at the retail level. Now, that was a little bit more mixed. It was forecast to be up 0.3%, slightly up higher than the 0.2% in July. Well, it actually came in at 0.4%, so one tick over forecast. And again, that's a monthly number. So 0.4% was the actual number for August, slightly higher, one tick higher than was forecast at 0.3%. The year-over-year number also came in at 2.9%, a little bit higher, two ticks higher than in July, but actually right on target as to forecast. So the CPI was basically flat to slightly higher. Now, what's interesting, though, is if you look into these numbers overall, inflation, while up slightly, is still pretty darn stable. And I think what's going on here, as I mentioned last week, the market in terms of focus is shifting a little bit. Remember, the Fed's mission is two things: full employment, which is generally defined by economists as a 4% unemployment rate, and 2% inflation rate. So inflation seems to be less of a focus because it seems to be, even with a slight uptick, at least on the CPI side, it's still relatively low compared to where we were a year or two ago. And so now the focus is more on the labor market. Of course, earlier this week, we had the Bureau of Labor Statistics revise the jobs numbers downward by 911,000. That was basically for the year running from the second quarter of 24 through the first quarter of 25. So that number, of course, put even more focus on the labor market and the perception that the labor market is weakening. And of course, that is where that shift has occurred. The Fed now is much more focused on the labor market and what appears to be some softer numbers in terms of jobs in the labor market. Inflation seems to be a little bit less of a concern. Now, the other thing that was on this slide this week, or that's not on this slide this week, that came out, the weekly unemployment claims. Now, that did jump to 263,000. That was actually the highest in 4 years. And the market did react quickly to that. That was, again, part of why we saw these bond yields improve this week, and today in particular, and yesterday. But when you kind of peel the onion and dive deeper into that number, that 263,000 unemployment claims this week, or last week actually, guess what? Most of that is attributed to the Texas floods. So then you look at that, from a distance, and then you say, well, really, is this that much of an indicator of a softening labor market, given that it was about 30,000 more claims than has been the case the previous week? So nonetheless, overall, the market is about 90% sure that next week's Fed meetings, which runs Tuesday and Wednesday, we're going to see a reduction in the Fed funds rate. However, while at some point earlier this week, the talk was we might see as much as a 0.5% reduction in the Fed funds rate. Well, as it turns out now, with that that inflation, the CPI number ticking up just slightly, now suddenly the belief is we're not going to see a 0.5%. It's most likely going to be a 0.25% reduction in the Fed funds rate. But again, even if that happens, I'll caution you, as always, don't get too excited about that. That doesn't mean that mortgage rates are going to be down 0.25% next week if that's what the Fed declares, because they're going to control the Fed funds rate only. It doesn't directly correlate to mortgages. So we'll see what happens to the bond market after that change occurs. If that drop of 0.25% does occur, let's see what happens with the bond market, because that will dictate where mortgage rates go. And again, don't forget, a year ago, the markets, the consumers, everyone was really ramped up about that 0.5% reduction that the Fed did last year. expecting a substantial improvement in mortgage rates. When they did that, and within a month, 6 weeks after that, guess where rates were? 1% mortgage rates, 1% higher than they were before the Fed lowered that Fed funds rate 0.5%. Now, I'm not saying that's going to happen again. There's a lot of factors that go into that, but whether it's 0.25% or 0.5% next week, be cautious. Don't get this expectation that you're going to see mortgages fall by that same amount. It just doesn't work that way. So with that, we're going to go back to a subject that I've covered quite a while ago, and that has to do with loan originator compensation. And the reason I want to talk about this is, and you may not know this, but the Consumer Financial Protection Bureau is now re-looking at loan originator compensation to potentially make some changes to it. And some are even arguing that the current rule, which is a 3% limit, could be lifted, if not revised upwards. So I want to get into that because I want you to understand what that could mean for those of you out there who are either borrowers or prospective borrowers in terms of buying a house. What does that mean to you if something changes with this particular rule? So that's what we're going to get into right now. So first thing, is this this 3% loan officer cap or loan originator cap, is this good or bad news for lenders and borrowers? Well, the article I read about this, the focus was basically about the 3% cap. That's kind of an abstract. Let me first maybe comment on what does that actually mean. What you may remember is, and we covered this months ago, when we originate a loan, or actually when we sign up with a lender to deliver loans to them, one of the things we have to do, and actually I just did this with another lender we're signing up with this week, we have to declare what we want to be paid when we originate a loan and deliver it to that lender. And we are presented with a grid that we are able to choose what we want for our compensation, and the grid will show a range from 1% of the loan amount up to 2 3/4% of the loan amount. And so we pick where we want to be in that range. Now, you might ask, well, if the cap is 3%, why would the lender have their comp grid that we have to choose from cap out at 2 3/4%? Well, that's because every lender we deliver a loan to, they have some sort of flat, I call it a flat fee. Most of them call it an underwriting fee. Some call it an admin fee. Some call it a lender fee. But generally speaking, it's about $1,200 plus or minus. It's even more on non-QM product where it can be up to $1,500, $1,600. So the idea is this 3% cap is intended to cover not just what we get compensated for as the originator when we deliver that loan to the lender, but also it has to take into account what the lender is charging their flat fee. So 2 3/4, if we were to choose that, then the remaining 1/4% is supposed to cover that lender fee so that the cap overall is at 3%. So that's basically how it works. And the idea here in terms of what's going on with looking at this cap and making changes to it or even getting rid of it, in part has to do with the belief that with this cap, it's creating a potential for some markets to be underserved. In other words, there are parts of the country where the median home price and therefore the loan amounts are much, much lower than they are in other parts of the country, such as Southern California. Yes, there are communities out there where the average loan amount might be, $70,000, $80,000, $120,000. So the argument is, if the originator is going to get paid a percentage of the loan amount and it can't exceed 3%, including the lender fee, well, they can't make a living. They can't profitably originate those loans if they're dealing with extremely small loan amounts, and that can have a detrimental effect to those particular originators in those markets and can create an underserved situation where they essentially don't do business in those small markets, and then those borrowers are left to deal with larger national lenders who of course aren't located locally and they're not able to therefore be able to get well serviced, and in a lot of cases get the kind of terms that they really should be entitled to. And so that's what can happen is you're going to have a case where low cost can reduce services with this cap in place. So that's, I think, a very important concept to understand here is that, having this cap, the belief is going to affect those small markets. But again, in this area here in Southern California, you don't have that situation going on. So the other thing I want to point out is, and as Jeff's pulling up here on this on the screen here, if fewer brokers can offer services in your area, as I just said, you might end up with a larger lender or chain and have to make trade-offs in service quality or loan product variety. So that's why it's important to understand why this is even coming up. But in my mind, what's going on there is if CFPB is going to look at lifting this cap because of this concern, what I'm a little concerned about is what can happen in terms of the larger markets, such as here in Southern California, where if there isn't a 3% cap, would that open up the potential for maybe abuse by lenders here more locally in these larger markets where their loan amounts are larger, where they may actually try to get even more than the 3% as their compensation. So in my mind, that's the watch out for. But so keep in mind that because we're in Southern California, we have decided to attack this in a different way. As Jeff pulled up here, flexibility versus fairness. The idea here with the cap initially was to help you or help keep the borrowers from being steered toward more expensive loans. So that's what the 3% cap initially was put in place to protect. Keep those borrowers from being essentially overcharged for the loan. And so that, I think, overall has been relatively effective. But again, with that concern about these smaller markets where the loan amounts are much lower. And so as a result, there's a scarcity of smaller, more direct to the consumer type originators for those people, those borrowers, to be able to get well served and get good quality service and so forth. So one of the things that we have done, as we've talked about before, is we decided quite some time ago, given this cap, we determined that we didn't want to be at the upper end of this range. Okay. Remember, I said we are presented with a grid where we have to choose our compensation between 1% and 2 3/4% of the loan amount. So certainly in our market, that is I think, a very generous spread or grid to choose from. If you're in some small community in the Midwest or somewhere where your loan amounts are very small, not so much. But here, we made a determination some time ago, do we really need to make 2.5, 2 3/4% on that loan when we originate it and deliver it to the lender? And the concern that we have is if we did that, what does that mean in terms of the rate that we're going to be able to offer to the buyer, to the borrower? Because what this compensation is all about is when we make that declaration, that means the lender is going to be paying us our compensation. We don't get paid by the borrower directly at all. Instead, when we declare that percentage in that grid, that percentage of loan amount that we want to get paid, when the lender pays it to us, how it squirts out to affect the borrower is not in a cash cost of paying us, 1.5, 2.5%. It comes out to the borrower, it squirts out in terms of a higher rate. And in our mind, that does two things. Number one, I think it potentially gives the borrower a rate higher than I think they're entitled to get. They should be able to get something better. And frankly, it's a phenomenon where we would be choosing to get, make more money per loan, but at the expense of not being as competitive on rate as we want to be. And we don't want to go there. We believe that with a standard loan file, whether it's a $70,000 loan or a $700,000 loan, for the most part, the amount of paper we put in that file and then we deliver to the lenders, it's about the same. The process is about the same. So does it really make sense that if we're doing a $700,000 loan and we want a 2% lender paid comp, that we should have $14,000 of compensation for putting that loan file together and getting it submitted to the lender, versus if it's a $70,000 loan, we're going to make $1,400? Yeah, I mean, that is an issue. But for us in this market in Southern California, we don't feel that we need to make that much money per loan, because we believe that means we're going to do fewer loans because we're not going to be as competitive on rate. And in these days, competition is severe, it's fierce, and we need to put the best foot forward in terms of rate in order to be able to be as competitive as possible, and frankly, give that borrower a better deal that they deserve. So we decided some time ago, as you can see on that second bullet point here, in Southern California, in that context, we don't charge at the upper end of that grid. We charge a 1% origination fee for the loans that we originate. That's what we declare to the lenders we deliver loans to. So when we close your loan, that lender is going to send us our compensation at 1% of your loan amount. We do add a small flat fee to that as well, but basically we are on the very low side of that 1 to 2.75 rate grid, or compensation grid. And what that means is a better rate for you, our customer, our borrower. And we believe we can, and we are operating our business at a profit margin that is satisfactory. We're making a living, we're paying the rent, we're paying our overhead, we're getting a good return on the products and services we offer without having to overcharge you. I've talked to many of the wholesale lenders we do business with, and they tell me that the average broker, who, the company with the same structure, origination broker, mortgage broker that we are, their average broker has lender paid comp closer to 2% of the loan amount, not 1. We don't want to be there. We want to differentiate ourselves on price, i.e. on rate, and yet add into that our expertise, our experience from decades in the industry, so that you're getting the best of both worlds. You're going to get a better rate from us, and you're going to get that rate in a process that we strive always to be much more smooth, efficient. We keep you fully informed. We're fully transparent. I always urge borrowers, when you're looking to deal with an originator and place your application with them, don't be bashful. Ask them what they're going to get paid. Ask them how they're going to get paid and what they're going to get paid. And I encourage anybody that does business with us to ask us the same question, because I'm going to tell you. And I'm going to show you what that is so that you understand what you're getting. So yes, on the one hand, the 3% rule can be restrictive for those in small markets with small loan amounts, but for here in Southern California, it's not restrictive. And my worry is, if the CFPB lifts that cap, some brokers in this market, in these higher cost, higher loan amount markets, may choose to go even further the other way and try to make even more money per loan, rather than doing as many loans as possible and offering the borrower the lowest rate possible. Now, one of the things that we also do, and I think this would help deal with the issue of lower loan amounts, whether they are a lower loan amount transaction here in Southern California, which, guess what, people? Sometimes I do. I've done many loans that are 80, 100, 100,000, 120, 150. And so what can happen there with this 1% rule is, yeah, we could end up getting paid, a pretty small amount of dollars to originate that loan. Well, with almost every lender we deal with, when we submit that lender paid comp request, we are allowed to put a cap on the minimum amount. And in most cases, we do have a $2,000 cap. So what does that mean? Well, that means is if we're going to originate a loan for $120,000, even though our 1% would normally mean $1,200 is all we would get, which frankly in this day and age is a pretty modest amount of money to fully process and get a loan closed for one of our customers. Our comp minimum is capped at $2,000. So on that $120,000 loan, we are going to get more than 1%. So that's really how it works. And in my mind, That's what's going to happen here if the CFPB makes any changes to lender paid comp, is rather than lifting that 3% cap, because I think it's potentially going to be abused by some brokers, even in high cost markets. Instead, allow those caps, those minimum uh, thresholds to be put in place in all cases. Because some of the lenders we deal with don't allow for us to put in a minimum amount of compensation when we declare our 1% is what we want. And so, frankly, that can be an issue in terms of where we're going to place this loan. And the reality is, even on the regulatory side, when it comes to calculating APR and so forth, the allowance as to how high the APR can be is higher for very small loan amounts. So as a consequence, the same approach can be used when it comes to lender paid comp, to where the 3% cap, I think, can still be in place, but allow the originator to put in a minimum amount. I don't think it really should be much more than about 2,000. That way, you're not shutting out those borrowers who need those lower loan amounts. They can avoid being underserved by kind of compromising and keep that 3% in place, and then at the same time, um, be able to make a decent amount of money when we are originating a very small loan. So with that, the last thing I want to point out is, you know, we have tried as very hard, therefore, to make sure we are providing you, the borrower, um, the best we can in terms of a combination of the most attractive rates possible, combined with exceptional experience and industry know-how in terms of making sure you're going to get the best deal possible from all perspective. One of the things I tell borrowers, and even more so real estate agents, is that when you're going to start shopping around for a mortgage, I think that's a good thing. And I think you need to do that. But when you do, you want to make sure, like I said earlier, you want to ask, uh, how do you get paid? And you're going to ask the originator, how do you get paid and how much are you getting paid and by whom? So you want to make sure you do that. If you're a real estate agent, a lot of you real estate agents have particular lenders that you favor and you tend to do business with. That's great. We try to have realtors that we do business with on an ongoing basis. But at the same time, I certainly have no issue with and encourage any real estate agent, if you're going to refer your clients to get a mortgage loan, and you're going to refer them to maybe a preferred originator that you have, it's not a bad idea when you're doing that to give out a couple of names, maybe two or three. That way, what you're going to be doing is you're going to be giving the borrower an opportunity to get competitive quotes. And what you're going to see is that there's going to be some differences in what's going to get quoted based on how each of those originators are getting paid. We've built our model on the idea of going low on that comp plan, 1% plus a small flat fee. That way, we're going to give you the most competitive quote possible, so that when you're comparing, when you are shopping around, you're going to be able to get a better understanding of the fact that there is some difference in rate from originator to originator. For example, and I'll kind of finish with this, at our 1% comp right now, when we are pricing out a loan, like I priced one out this morning, at our 1% comp, I was able to quote a 30-year fixed conforming loan. Loan amount was about $420,000 at 5 7/8. Well, let's say I was a broker who didn't have a 1% loan originator comp, and I had 2% instead. Well, I wouldn't be quoting 5 7/8 at 0 points. I'd be quoting 6 1/8, a 1/4% higher in rate, simply because I chose to ask the lender to pay me 2% of the loan amount, not 1. Let's say I'm at 2.5%, because you know what, folks? There are brokers out there who ask for 2.5% in their lender paid comp. It's true. There's a lot of them out there. Well, if I was one of those brokers, I wouldn't be quoting 5 7/8, 0 points. I'd be quoting 6 3/8. That's a 0.5% higher in rate, simply because I chose to ask for a higher lender paid comp from my lenders instead of going low end on the scale. So that's an important distinction. I know it's kind of hard to track, but that is where you're going to see a difference in what kind of rate you're going to get because of what the originator is getting paid uh, based on what they declared they wanted from the lenders they do business with. So I can't underscore that enough to keep that in mind when you're shopping around and making sure that you're asking the right questions, that you're getting straight answers as to what the person you're doing business with is going to get paid and how they're getting paid. Because after all, think of it this way. Whenever you're out there looking to buy any product or service, you're usually not going to do so until you know how much it's going to cost, right? In the mortgage business, that can be kind of a fuzzy subject, hard to distinguish as to what's really going on there. It's not like when I approach to originate a $500,000 mortgage that I've got a price tag on it that says it's going to be X amount of dollars. Buried in the disclosures, there's going to be some information that will give you a clue as to what's going on there. But look, ask the questions. If you're out shopping for a car, you're going to be looking for the price sticker to know what the car costs. You should think of it the same way when you're getting a mortgage. I'm happy to have that discussion with you and happy to show you in dollars, in writing, exactly how that works, because that's how we built our business model. That's why we're in this for the long term. That's why we want to do as many loans as we can for as many folks as we can and combine that very attractive rate, that very, very low rate compared to most of our competition, but with the added value that we know what we're doing. We have the experience, we have the expertise to ensure that you're going to have a smooth transaction from beginning to end for you as the borrower or as the homeowner on a refi, and in particular for you as an agent who is representing a buyer on getting a home purchased. We can help you get the best experience possible, both in rate and expertise, to get that closing done in a smooth and efficient manner. So with that, I'm going to conclude our this week's Mortgage Minute. My name again is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. I want to thank you for watching and listening. Have a good weekend. Again, as I said earlier, a lot to reflect on and think about as we go forward, and please do that. And then I look forward to seeing you next week on the next edition of the Mortgage Minute. So long. Take care.